video. All right. So back.
Yes, I do, but it is like this small. It's not the main screen. The main screen I see right now is stock Taylor Swift.
Yep. I get it. All right. So let's get away. Put that back up to there. That works. Alrighty. Well, good morning, and how are we doing today? So we're gonna go through things now. Number one, I like. Oh, let's do this. Do you have the ability to open up your television and go to YouTube on your TV in the other room?
You mean me?
Yeah, you.
I'm using my computer right now, so I think I can see it.
Okay. So if you pull up your YouTube, what am I doing? All right, let's do that.
Going to Dividend Stock Talk.
No, on YouTube it would be the 10-minute trader on YouTube.
Right.
Trying to get. Oh, that's why it's not working. Okay, so that will do just a couple of those. What do you call those things? Right. So let's take a gander. Now, the difference between a spread, a calendar spread, a debit spread, credit spread, there's literally hundreds. But exactly. Right now, you know the single, and you know the covered. That's what you know, right? Okay. Well, vertical, cool, capital. So why don't we look at those two today and go from there? Because the vertical is easy, it's simple. Well, let's do it. All right. So verticals. Once you decide the stock is going, but in place here, you think high, you 30, and coming up. All right, fine. Well, let's do a couple of spreads. I'll be on for you. Number one, the cash spread. Also called. Because what we're going to do is we're going to go into the future and buy a option to buy the stock. So you get two choices: you can buy stock, or the option to buy stock. You're not obligated. You just get the right to buy. All right. So that being said, I should probably put on a different shirt because. In. So I might as well put on the regular shirt. Who the heck this bonehead is?
Actually, when I look at the YouTube channel, all it is the video on Dividend Stock Talk. That's all. The only live I see of the trader is on your channel.
Well, that probably yeah. You should see the screen me standing in front of the screen.
Well, I only see the screen and you in a small part in the bottom right.
That's the one. Okay, but you see the screen. Okay, so that's going to allow you to see the little tiny numbers, so they'll make a little bit more sense. And what I'll try to do is I'll try to make it bigger for you to be able to see them. All right. All right. So when we're looking at the okay, 30 days, the last 30 days. Up, down, up, down, up. Here's the high, down, here's the bottom here. So this is the part where it looks like she's going to start going up. Well, we can agree on that because it looks like it's going up. I mean, it just looks like it just is. Right, anyway, so currently at 870. I think that's where she's going to be. What are we going to do in order to be better positioned to make a profit? Now, you can buy the stock and have it run up, or you could do an option. Now, buying just the option, okay, fine. I don't want to go too close. So as you look at some of the dates, okay, October 31st, that's this coming Friday. November 7th, next Friday. November 20th away. The 21st is 27 days away. The 28th, 34 days away. And then we get into December. That's 41 days away. Now, all of these are weekly options, so you can jump in and jump out anytime you want. So the calendar spread, get two choices. So let's do one at a time. Let's do just the covered call. All right, and then we will take a look at the rate of return for each one. So the covered call, we say 49 because that's space stock is at the moment. All right, so if I the 49, okay, one, all right, and market order. There we go, and by one covered call HIMS, HIMS, 100 at 31 October 5. That means the option is going to expire this coming Friday. So what rate of return will be just this 1 week. All right. So the 49 call against HIMS at the market to open, blah, blah, blah. Break even 10.20. Well, stock's at 48.78, so that looks like a good position. But the max profit is 179 and the cost of the day is 7. So let's get up the calculator to do it ROI so you know what it is you're looking at. But before I do that, check this out. What I'm going to do. What am I going to do? Now, this. I'm going to do that. And I'm going to do this there, and we're going to go right there and pull it right to there. All right. So that's the order right there. So we're going to. So that one is saved. Again. Well, before we do, let's have to return this so we can write it down. We're going to enter. 3 point. I do. All right. So put 3.8%. There. Okay. There it is right here. All right, let's make this smaller. Take this one. Nope, this one right here. This is the one we did. Him right there. Him right there. Okay. So push those over that way. Bring the one over here. And we're going to put this one up. Bigger. Outstanding. All right. What did you say the number was?
3.8%.
3.8%. Oh, I like that. What do you think?
Looks really good.
Okay, so we're going to take this, make it smaller. We're going to put it over here. And now we're going to go back and find another one. The same stock, but we're going to do a different trading strategy this time. All right. So let's get rid of this one. Now, to a vertical. Let me explain to you how a spread works. What we're going to do is we're going to buy one option and then we're going to sell another one. Okay, so considering the stock at this moment in time is at 421, let's buy the 48. And we'll explain how that works. The 8.
For different prices, you can't write that anyway.
Okay, so this is what it looks like. We're going to just go and do contract. Whoops. You see, right? We are going to buy one vertical HIMS, which is, we're going to use the same stock so we don't, vary. So we're going to buy one vertical, which means we are going to buy the 31 October 25 $48 call option. And then we're going to turn around and sell the same bought a different strike, the 49. So buy the 48, and we're going to sell the 49s. And what it cost me? It cost me 49. Exactly. If I'm paying 47 cents for that contract, what's the make?
53.
Exactly. That 100% return, correct?
Right.
So what has to happen in order to make 100% return? It has to stay above 49. Well, price 78. Well, the last traded price. But look at the aftermarket price. The aftermarket price is 40. This stay between 48 and 49. Now remember, if it's at 48, 47, that's even. So you make 48, 47. It's only once the even price, 48, 47, do you start to make money. Now, if it's at 49, 49, 49, 50, you still only the difference between the 48 and the 49, which is the 53, which is more than a 100% return. Do you see that?
Yeah, I do.
So where's your risk? Your risk is 1%. It's 100% risk. Friday, you get absolutely nothing. Big risk, big reward. You have to pay $48 for this option. You're buying the option, the 48, selling the other option, the 49. So yours is 48 cents per share, or 47 cents per share. And the maximum you can make in this is 53. That's why it's called spread, the difference between the purchase price and the strike price. It's only $1, but you're paying 47 cents for that $1. So if the stock stays above 49, you made 100% return. Well, if that's a little bit too tight, a little bit risky. Well, the stock's already above 50, so the stock doesn't have to move at all. This is one of my favorite ones, is doing an in the money debit spread, because the stock doesn't have to move. So let's look at that one. Wait a minute, before we do, let's find out this one, and we'll save also. So run the $50. Okay, it's the thing divided by 48. Yeah, 48. 48. So profit on this one is 109%. All right, well, let's write that one down. So let's this.
So you were talking about a debit spread. How's that different from a credit one?
Hold on. All right there. There, and we want to see it. Okay, there. All right, here it is right there. Okay. Now this one was 1.09, correct?
Right.
109%. Okay. Make that small. This one is a covered call. Let's go back. Let's find another one. Okay, so that's the credit spread. That was yes, spread. So a credit spread. All right, vertical.
Debit, and then we're going to show us credit.
Correct. All right.
Right.
All right, credit spread. Okay, we want to sell one and buy another. All right.
Oh, that's the opposite, isn't it? Buy the vertical one is buy something and then sell. This one next time is sell and buy.
Correct. Now we're going to change this one from the 48 to the 48.50, which is this one right here. Let's do this one, and then we'll go. All right. Okay. It is another credit. Using the exact same stock, we're changing 48.50. The stock is already at 48.70. So we're doing 48 and we're selling at 40.50. So hymns 31 October. The 48.50 call option for 23 cents. That's what we're buying. Now, it's only a 50 spread. The spread is and the one you see. So the maximum you can make on this trade is 50 cents. Okay. You're paying 23 cents. So what's the maximum you can make on this one?
27.
Isn't it 23? No, 27.
Right.
So you can make 27 cents right now. That's money, but you're buying it for 23. That is again over 100%. But here's the thing: the stock is already at 48.78. So what are the odds and probabilities of this thing being above a 48.50 by this coming Friday? It's a higher probability, isn't it?
Right.
So if the stock goes up, I'm good. Stock stays the exact same, I'm good. As a matter of fact, the stock can even come down a little bit, and I'll still be good. As long as it's above 48.50 by the time Friday comes. See that?
You mean above 48.23, a break even?
No, don't worry about that. Right here. Because I'm buying the 48. I'm selling the 48.50. I'm selling it for $48.50.
Right, I get it now.
Okay, so I'm buying it, it's already in the money, and I'm selling it, that's already in the money, but what am I paying? I'm only paying $20. So what's left? 26. So is more than 100%. What happened? The stock has to stay with it.
How did you get that 100%? Like, so it's 26 minus 24.
Okay, hold on.
So yes.
Hold on. Do you understand the concept of a spread? You're buying one, you're selling the other. What's the maximum you can make in a spread? Buying one, selling the distance between the one you bought and the one you sold. So if I bought it for $48 and I'm selling it for $48.50, the most I can make is only 50 cents, right?
Yes.
So if I'm paying 23 cents for that position, the maximum that I can make is 27 cents, correct?
Yes.
27 and 23 comes to 50 cents.
All right.
If I'm paying 27, more than 100%, correct?
Yes. Right.
All right. So if the stock is above 28.50, stays exactly where it is between now and Friday, that is over a 100% profit. And what does the stock have to do? Absolutely nothing. It stays exactly where it is. Do you understand?
Okay. Let me go through this again. So
Okay.
23. We're paying 23, and we get 27.
Your maximum profit is $27. And how much did you pay? Well, it's actually 24.30 because you get the fees.
That's
24.32.
right.
So just $25 and have 68 cents. Well, let's call it 26 bucks. You're only going to make 26 bucks. And it's 24. Now, isn't 26 more than 24? Do the take 26,
So-
you divide it by 24, that's over 100%.
Okay. Yeah.
So that makes sense?
Yeah, that makes sense.
Okay, so let's save this one also. It's a small spread, the 48 to the 48.50. So let's do this. Let's do that. Let's do this. Let's do that. Lovely. Come on. And there you are. And let's go to that one. There it is right there. Whoops. Why? There it goes. Rate of return for this one. So the calculator. My investment is 24. That gives 111%. That is another.
Okay.
There we go. 3.8% for a covered call. 109 for debit spread for the $1 spread, and then 111 for the 50-cent spread. Still, they all look pretty good. Okay, so well, you always take risk, reward, and then figure out where is your risk reward ratio. Are you comfortable with this? Because remember, if you're wrong, you get absolutely nothing, and you lose 100% of that bet or that trade. That's why we add. And then we are adding the safety. So,
That makes sense, yes.
all righty. All right, so what one do we want to do now? Oh, the calendar spread. Let's do that. I'm still trying to wrap my head around the credit spread because you sell one and then you buy another, which is less, and then you get credit on that.
It's just like buying it. Just like this.
Yeah, but see, this one here, you can't roll this forward because this is for 31 October and this is 31 October. So they both expire this coming Friday. So there's really no safety net for this one. So you really can't roll it in next week. Now, spread, also known as all right. Then there's a lot of moving parts, but basically saying it's buy the option to buy the stock, which means we have the right to buy at a certain price at a certain time, just how far in the future you want to go. Well, safety is for because that's when the time value starts to accelerate the downside. So the theta decay or the time value accelerates it's like a sprint to the zero, so to speak. Okay, you understand that? Sprint to zero. So from 90 days to 120, 160, 300, anything is almost zero time. Like, and then the short, well, that would be this week. We're looking to get out on the, but we're looking to jump in 90 days out. That would be so we do one right here. We want to do the 48 because that's at the moment. We're going to take from November 7th all the way out to January 12th. That gives a time value on the option which we buy the stock. Way out in January. We just have the right to buy it at this price. All right. What we're going to sell someone the right to buy it from for the exact same price it's at right now. So if the stock is currently at 40, okay, we're going to do the 48 for January. We're going to do 48 for the going to cost us. Well, let's find out what that number looks like. One contract. Oh, super complex equation. Well, let's tell you what the super complex equation is. We're going to do that. Give me one. Go to Scholl's equation. Wikipedia. Equation. Where is it? All right, I'm going to cut and paste so that we can make it bigger. So you please. There it is. Actual. Come on. There it is. So I'm going to save this, and then I'm going to pull it up. Big. Black-Scholes. All right. What do we do next? Dang it. Search. Pricing. Come on. Why is it taking so long? Oh, you know what? I'm going to do it. Now pop up. Right there. Right there. Right there. That's perfect. Right there. All right, you're at 80. Here it is, right there. Look how tiny it is. Wow. It's so small. It's so tiny, I can't make it bigger.
It's okay. I can see it on my computer.
Yeah, but I can't see it.
Yeah.
the Black-Scholes pricing methodology for stock options. How the hell do you read it? So what's in there? All right, well, you got the stock price, you got the option price, you got implied volatility, you have time and time decay, which is the time from when the option was first exercised or enacted or started until its expiration. That's called theta decay. How much time between when the option first came live and to its expiration. That's theta decay. But this is the option. How you come up with the price for it. It's a very strange equation. Look at the size of it. It's huge. Oops. But that's it. Black-Scholes pricing methodology for size options. It's really complicated as hell.
So then what does the time decay actually have to do with, like, and then risk from your calendar spread that you're doing here?
Time decay doesn't have anything to do with that. Okay, look at it this way. Each option price has time decay in it. So we like weekly options because weekly options rapidly decrease to zero within the last 7 days, which is last week, which is what we're looking for. We're looking for the option that we sell to go zero as fast as possible. Well, there's absolutely no time decay at 90 days. So if 90 days, 107 days, 140 days, so on, further out you go, you eliminate that one part of the equation, time decay. So the stock price and the option price don't move very much from each other at 90 days and past. But as you get close to expiration, as the time slowly ticks away, time decreases exponentially. That means a lot faster. So closer to expiration, the time value option decreases rapidly. So that's why we buy one on calendar spread further than 90 days, and we sell one within 7 days. Because we want it to go to zero. We wanted to sell it for $1 and have it go to zero or go to a penny or two. Because that's our thing. Okay? And then as the one from 90 days, as the time ticks away, we can take it and we can push it out further, rolling it into months further out, if you want to continue the path. But the funny thing is with the options, as opposed to the stocks, when the stocks go up and down, the value of those go up and down also. So what is your rate of return going to be? Well, that's as is, so does the option value. So as the sands flow through the hourglass, so the dollars out of our pockets. Look at it that way. That makes sense?
Yes, makes sense.
Right. So let's look at it and see what kind of rate of return it is. Well, on a calendar spread, looking at the wrong one. Okay. The calendar spread, we're going to, there's my pen, all right. We're going to buy one calendar, HIMS. That's HIMS. Okay. So we're looking at 16 January 26. Well, that's more than 90 days away. So the value of this option is not going to go up and down a lot based on the movement of the stock. So as the stock moves, yeah, it'll move also. But there's no time decay at 90 days. Well, there is, but it's so small, so minimal, it barely even counts. Okay, so we're buying January. And then we're selling this coming Friday, the 31 October, which is this Friday. Now, for that, we are paying okay, I want to change that to market. Well, the challenge here is, though, we're not going to know what our rate of return is going to be because the value of January 16 and this one right here is different. Let's go for what they are. Let's.
It's hard to find what profit we're going to get.
Exactly. Because when you first start your calendar spread, it's going to be right. And then as of Friday, when you decide whether to get out of that position or to extend it for another 7 days, the value of the one that we bought January 16 is going to be different. So with a stock, you buy it, you know what your entry price is. Well, wonderful. But on a calendar spread, or poor man's covered call, you're jumping in at this point, but on Friday, it's going to be a different number because of time decay. And then next week, that number is going to be different again. And then the following week, every single week, the option that we buy, the January 16, is slowly going to decrease to 0. But how many days is that? Hold on. How far out is it? Wait, before we do that, look at this one. Okay. All right, and there. All right, there and there. There. See if I got that right. There it is right there. All right. All right, so there's the calendar. Let's find out what the rate of return on that's going to be. In order to find that out, we've got to go back to find out the value of the option. We're not going to hear. No. The 8. Back to single. Let's get rid of this. Okay, so the 48 for this week, right here, is going to be 233. All right, see that 233? That's the one that was. That's this week's 233. That's what we're selling. Which one are we buying? January 26, which is right there. Okay, so, okay. Right, so 940, and we're selling 233. So let's get the calculator. Okay, the one that we buy right here, the 48, 940. That's what we're buying it for, and we're selling this 48 for 233. So we take the profit, 233, and we divide it by the investment, which is 940. Divide 940, and that's a grand total of, let's call it 25%. Okay, that's 25%. But here's the thing. That's 25% today. When Friday comes, those numbers are going to be different because of time value. And as the time slowly ticks away, so don't the numbers. So we're going to save 24%. We're going to put it on. We're going to put it right here.
All right.
Whoops. 24%. Now that is a calendar spread. Calendar spread. All right. Whoops. So we've got 4 of them so far. How many more do you want to learn? There's a whole bunch of them.
Well, you said that like the least riskiest trade you could ever do.
Correct.
So I mean, again, with my time zone problem, I might lose money because I cannot make alarms and check the stock's price. Wondering if there was like another way to get out of that, but it doesn't look like that.
Well, no, because each trade that you do has its own risk factors come along with it. Okay, the covered call, it's simple, it's safe, it's predictable, and it's consistent. That's the way I like it. It's 3.8% for this one that we looked at this morning. The exact same stock. Well, here's one right here. It's called the debit spread. the 49. Well, the 48.49 has risk to it because the stock is not at 49. It has to go up higher. So once it hits 49, yeah, you get a possible 109%. Well, great. Well, let's drop it down to the 48.50. Same stock, same scenario. 48.50. That's 111%. Okay, and then you get the calendar spread. It's a little safer because you have the option all the way out to January. Now, this one and this one, well, they're going to expire this week, so it's hit it or get it or don't get it. It's yes or no. There's no ifs, ands, or buts about it. You're either going to make the money or you're not. It's plain and simple. But this one here, you can every single week, 1, 2, 3% every single week. This one here, the calendar spread, well, yeah, the first week you get 24%, nice. But as the time goes through the hourglass, so do the dollars, our pockets, however you want to call it. But as time goes by, the value of both of these, January 26th and 31 October, are both going to disintegrate faster. So there's always
happen if I roll forward.
Absolutely true. But the January, the one that you bought, the long one, like 3 months away, that one is slowly going to decrease as time goes by. That's like the one that we did with Dividend Energy. Now, we bought Dividend Energy a year out, and every single week we're bringing in something. But also every week, as the stock goes up, so does the value of that option. As the stock goes down, so does the value of that option. The one that we bought in March and June of next year, they're slowly going to decrease. So you got to remember, a covered call is the simplest, safest, and most predictable. It gives you 1 or 2% a week. Okay, well, 1% a week is 50% a year. 2% a week is 100% a year. Not as good as this one right here, 109%, but you have to be right. And if you're not right, you lose 100% of your money. Same with this. If you're right, great, it's 111% return. Well, that's awesome. But if you're wrong, you lose everything. The calendar spread, 24%. Not as good as the regular spread, much better than the covered call. And again, both options, both the one in January and the one for this week, are both rapidly racing to the finish line of zero. They're rapidly decreasing in value because of time decay, also known as theta decay, one of the Greeks. That make sense?
All right, that makes sense. I guess then for my low risk trades in U.S. market, I better just explore that.
Well, the covered call is easy for what you're doing. You jump and you buy the stock. You buy a good quality company, one you're okay with owning. You sell someone to buy it from you for more than you paid for it. It's set it, forget it, walk away. And then Friday comes, it's either filled or get filled. If it gets filled, great. Monday morning, you pick something else. It's the simplest, safest, least amount of effort whatsoever. But like I said, you make more money, but more risk, more reward. Make sense?
Yeah.
Hey.
All right, that makes sense. Suppose I keep getting risk with my calls because I usually sell at a lower strike price than the current drop price just to get more profit. Because of that, I cannot end the time zone again. I cannot check on the price, and I can lose money from that.
Okay, well, in that case, you might want to change your strategies just a tiny bit to make sure that the calls that you buy, good quality company, great. That is what it is. The option you sell against it, you either buy it, sell the one at the exact same price, which you get that's where you get the highest rate of return at the exact same price. So at 48, and I sell it at 48, that's the highest rate of return I'm going to get for a covered call at the money. Okay, in the money, you get a little bit less of a return, but as long as the less of a return, you get a higher probability of safety. Because it's always going to be a balancing act. What is most safe to you? What is the best trade for you specifically? That makes sense?
All right. all right. I guess it's just up to me for exploring then, just to experiment.
Yeah, well, I just gave you these three right here. You can play with those. Well, you already know this. These two right here. Remember, at the money, this one, the stock has to go up. In the money, the stock doesn't have to move at all, but your percentage is less. Well, actually, this one's more than that one. Okay, so take your time. Play with these two right. You know, at the money, debit spread, in the money, debit spread, and then a calendar.
Right. So yeah, for the first strategy though, I like the simple one you are currently teaching. I guess I just like have to see what my odds are. Try to not sell at a lower price because that might introduce risks that I might not like.
Correct.
I don't wanna like having to check myself every time I have the stock doesn't go the way I want to.
Correct. It makes sense. But you know what is safe. And as you're ready to learn more and more and more, just take it one at a time. Now, covered call is great for less interaction, less time away. Now, the spreads, they will make you more money, but they require more time, more effort, and more risk. All right,
Right, that's good. Thank you for taking your time.
you have yourself a wonderful day and enjoy the rest of your weekend. Yay! What's the weather there now?
This morning it was pouring, freezing, but tomorrow will be nice again. Honest and sunny.
All right. Well, you have a lovely day, my dear, and we'll talk to you again next time. All right?
Right, thank you.
All right. Have a nice day.
Thank you. Bye.
And now.